Welcome to Revere Asset Management's Your Money with Danny Stewart
The market will always overshoot to the downside and to the upside.
and Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Sometimes, folks, the show just writes itself. I mean, it just writes itself, especially when you get a great article sent to us by one of our listeners. I appreciate that. But it's so funny. I was going to try to move away from all these things I've been harping on the last few months and months and months. But we got this article, and it's called "The Great Bear Market in Diversification Haunts Wall Street Pros." My comment is, well, maybe they're not really pros then. And are you playing the guessing game, aka forecasting, when you're investing, or are you guessing where to put money, or are you just spreading it out wide, aka diversification? That's what this article's about. At Revere, we like to call it diversification. That's Don's little sniglet that he made up. Or are you chasing high short-term rates, falling into, quote, a cash trap? That's an article on the Wall Street Journal, because you're scared and you want yields, and they're talking about a trap when rates do start to drop. Now, folks, all of these articles are in the show notes, so you can go look. But here's the thing. There's a great bear market in diversification. So if you got a diversified portfolio, you're making 3, 4, 5, 6, 7%, while the S&P and NASDAQ are making double digits. Or are you scared and just in short-term yields? Or worse, are you preparing for an event where nothing matters, gold, beanie weenies in a bunker? I got that article too. Stop. There's a better way. There's a better way to invest, and we're going to show you in just a few minutes. But before I forget, next week, we're going to have the show on July 3rd, the day before our great nation's Independence Day, July 4th, so that the guys can kind of take it easy and not try to do some stuff and try to sandwich it in on that Friday, wrapped around a vacation and then the weekend. Okay? Now, next week on the show, we're actually going to do a roundtable. We're going to do a June post-trade analysis report where we go over the actual management and the trades and investing for the month. We're going to just go through there. So if you're a client, you can actually kind of look and follow along and see what we did. We're going to show you how we manage drawdowns and risk. And that dovetails with what we're going to talk about. How can you be in the areas that are doing well, but control risk because it's, quote, too concentrated? Okay? Now, look, we know that a major correction is coming. At some point, we just don't know when. So, Don, what's that favorite quote you like to say? More money has been lost trying to avoid the next bear market than the bear market itself. God, I love that line. You can't let fear.
That's actually, I'm not that smart, Dan. That's actually Peter Lynch's line. And I think he might have been the diversification one too. Nothing's original except for it's not how much you make in the markets, it's how much you can keep. I haven't heard anybody else.
That's Don, we got. I just ordered a bunch of T-shirts with that on it. It's not how much you make.
I also haven't heard anybody else say diversifying into underperforming asset classes is like going to the store and buying rotten fruits and vegetables to maintain a balanced diet.
Oh,
that I'll take credit for that one too.
That's a little too long to put on a T-shirt.
Obviously it is. Yes.
So the other T-shirt we got made is "What's in your portfolio?" So in any event, folks, we want to talk about that. There's a better way to invest where you can participate, but yet protect the principal or most of the principal fairly quickly. And I'm going to run through a couple of articles real quick. That's talking about it's from Wall Street Journal, but it's also Wall Street, and they're all assuming asset allocation, aka forecasting, and investors, and they're assuming that investors have to decide whether, one, to sit on the sidelines, Two, redistribute money from the big money market balances that are paying 5% into longer term bonds before the rate cuts come. They're assuming rates cut, inflation's not going to reignite and rates are going to drop, and that's probably likely. Bonds will go up, okay, or invest in stocks at these scary all-time high levels. But how do you control risk and drawdowns? Now, here's a dilemma. You're hearing all these cross currents. Unemployment, initial and continuing claims up to a 31-month high. GDP is down to 1.4%, and it's slowing. Pending home sales. This is the canary in the coal mine if you really want to worry about something, in my opinion. Pending home sales is down 2.1% this last month after a 7.7% drop the month before. The low that those back to back 2 months are the lowest recorded ever since they started doing this particular measure in 2001. So the economy is looking weaker, but the stock market is actually showing strength. Technically, it's looking good. So what to do? All right. So very quickly, I'm going to go into the this article. I'm going to go. This great bear market diversification haunts Wall Street pros. We did everything right. We spread our bets far and wide in bonds and equities in case things went south. Well, the problem is a lot of that stuff they spread it out in did go south or just didn't go up while other things did. The big lesson, the futility in diversified portfolios. They've been up around 6% only because the market, the S&P's up double digit, right? Now, if you had international stuff, if you had a bunch of international bonds and you might be only up 3 or 4%. So that's the problem. It's the bear market in diversification. This Faber is talking about. He runs the Cambria Global Asset Fund, and he's got an annualized 5% gain. So the market is handily beating him, and now he's kind of complaining. Now, the proponents of these modern day allocations, known as modern day portfolio theory, push back saying fixed income assets allow investors to better match their future gains with future obligations. I don't care about the future. I just want to be either making money or protecting my money in a drawdown. Okay. Then it says, moreover, diversified portfolios went out in 2000 to 2008, a period where stock values saw their values cut in half on 2 separate occasions. See, they're thinking that it's either or, that they're mutually exclusive, right? If you and it's true, these big drawdown. First of all, if you have a way to measure so that you could get out of the way and miss some of that, you might not have those big drawdowns. Okay. But it also helps not having a psychological toll. If you got big drawdowns, man, it really screws with your head and takes a lot of psychological capital, and it's scary, right? Well, that's what these diversified portfolio managers are all complaining about now. The psychological toll they're going through, and now they're trying to market chase and chase the markets. And now they're trying to tell people, no, don't chase where the good things are. Let's just stay the course. But why do you want to hold underperforming assets? Okay. Now, one last thing, and then we'll go to the next one. They are also trying to get you to spread the money where they need it, where there's no love, because they think it's their money, not your money. All right. Now, the next article, very quickly, is, and this is kind of, it dovetails with the interest rates. The Americans are chasing high interest rates, falling into a cash trap. And basically it says long-term investors should return, this is more for fixed income, to a diversified bond portfolio to lock in long-term attractive yields before the Fed starts cutting rates. So they assume they know the Fed's going to, and I would probably agree. Wall Street is repeatedly, so furthermore, it said, why would you listen? Wall Street has repeatedly been wrong about the path of interest rates. Earlier this year, they thought the Fed would cut as many as 6 times, and now they're not cutting. Now, let me see, what's next? You should consider diversifying more before the rates start cutting and stocks take a big fall. Folks, if rates start to cut, stocks probably won't fall. They'll probably go up, and they'll probably go up more than bonds. In any event, this is talking about why you should not sit in cash. Here is the problem. Cash, treasury money markets now are paying 5.2, 5.3%. That's putting pressure on dividend stocks. That's why growth stocks are doing much better, because if you're trying to buy the stock for the dividend, hell, you can make 5.2% without any risk at all. Well, inflation risk, but without any principal risk, getting your money back risk, because the Fed has the printing press. It also puts pressure on bonds. You can make more money in treasury yields at 6 months and 8 months and 9 months than you can in a 5 or 6 year bond. So why would you own that? That's the problem. All this manipulation by the Fed causes distortions. But here's the problem. Now they're saying, now they are right. If rates start to come down, you're going to actually see a pop, probably stocks too, but in bonds. And when yields come down, and now the treasury money market's only paying 3%, 3.5% or 4%, now that yield's not as attractive, and you could have been in bonds. I get that. If you are an asset allocator, cringe when I say that. Zach's laughed when I said that. I couldn't help it. I can see him in the background. Lost my train of thought now. But if you are an asset allocator, it probably is a good idea to start moving some portions of your bond into longer term bonds. But folks, it's not all or nothing. They're acting like you got to do one or the other. You could put some money in there and then add on if you get confirmation and they start dropping rates. So with that, because this is very important. This is very important both for bonds and stocks. Bonds also have to be actively managed, just not nearly as actively as stocks. Folks, the top guys at Wall Street, the top senior level C-suite people at Wall Street, they don't hold bonds to maturity. They train their ropers, their salesmen, their commission guys to go, they're the roper, you're the cattle, they're delivering you to market. They're training their guys to give you a laddered bond portfolio and hold it to maturity, but they're trading the interest rate cycles themselves. All right, I'll get off my bully pulpit, and I'm just going to read the mailbag. Now, this is actually from a guy that I sent him this diversification article, the Great Bear Market and Diversification Haunts Wall Street Pros. I had sent this to him because, in full disclosure, he is a client. He's got some money with us, but he's also got some money with a large, prestigious investment bank up in New York. And now that he's with us, he's kind of struggling a little bit because he's seeing that they're in that big diversified pie chart, and he's only making 5, 6, 7% when the market's doing really, really well. Let me see. Thanks, Dan. The article really does get to the heart of the issue, and diversification comes up woefully short. Much appreciated, JW. That article was very telling, was it not? Now that I'm seeing lots of articles trying to get you to invest in these sectors that aren't getting any love because these areas need liquidity and funding. To Wall Street, it's about their money, not your money. And often, the bigger the investment bank, the worse the problem. JW, I agree. It's very eye-opening. The commentary is what you have been beating the drum on for some time. That's why I was actually going to move forward to a new topic, and I got this article. I couldn't help it. I actually sent the article to my BNY big bank in New York contact to discuss with her further. Film at 11. Question. Just blue skying. In my blank portfolio, I asked them to move me out of 100% of my bond portion of my portfolio. Are there any penalties to move into cash for some longer term positions? He's talking about bonds and why it's important to you if you have bonds. Okay. Regarding bonds, as long as they are liquidated properly, you should be okay. The price you receive will depend upon the demand and liquidity of that particular bond. Individual bonds are traded in large blocks generally, so a sale is small If the sale is considered small, the bidder, often a dealer, believes it a distressed sale. So with a smaller account, it could show up on your statement or even online at, say, 104.50 at a premium and get filled at 99.5 at a discount, just below par. I mean, you could lose 4% just trying to sell it. So on your statement, it looks 3 or 4 or 5% higher until you try to sell it. So anytime you're selling individual bonds, be careful. Get the broker on the phone. Look at the bid-ask spread. You got to do it right. The good news is with the large outfit, investment bank like his, with this large outfit, your bond trading desk should be able to get you appropriate fills, but ask in advance. Any blue sky capital gains on any bonds would be taxed as long-term capital gains rates if held over a year in a taxable account. So essentially, you would be turning interest income into capital gains at a lower tax rate. But whether taxable or not, even if it's an IRA, folks, the capital gains will go away and asymptote down to par, down to $1,000 a bond, as it gets closer to maturity. What I'm saying is that the capital gains will disappear as the bonds mature. That's why, folks, you got to book these gains. You could trade it out with another bond that's at par at a discount with the same yield. And then you're really going to increase your total return on bond portfolios. That's why you don't hold bonds to maturity. Anyway, what I'm saying is capital gains will disappear as the bonds mature. Any losses in a taxable account, you should book for a tax alpha. In an IRA, it's irrelevant. Therefore, bonds with large capital gains should be sold and book the gains regardless of the type of account. It's very important, folks. I need to ask, what is the reason for liquidation? Because if you are asset allocating still and having some fixed income anyway, then you need to pick and choose and be selective. Also, if you were being passive, rates are likely to come down and bonds would be okay. The time to really liquidate would have been the beginning of inflation and the Fed hiking. That's when you maximize gains. Inflation is kryptonite to bonds, even worse than rising rates. Let me know and I can look at it. Give me the QSIP and ticker. Let me know and I can look at any bond to see the sale price, the bid and ask spread at Schwab. I know this was a long-winded answer, but I wanted to be complete because this was specific advice. Folks, this is also good advice for you. If you've got a lot of bonds and you've got big premiums, they're showing at 105 or 108. Hell, they're probably showing a lot less premium now because when interest rates were down close to zero, a lot of these bonds were at 112, 120, 122, and now they're all back at 102, 103. They're still at a slight premium. But in any event, that's why it's very important. Do not hold bonds to maturity. If you want to talk more about that, just reach out to me. All right, next one. This is an article. It's also in the show notes. It's a Wall Street Journal article, so it may be a subscription to you. But the risk of having too much cash may be a good topic for a discussion on the podcast from MB. The title of it is Americans Chasing High Interest Rates Risk Falling into a Cash Trap. Investors must decide whether to sit on their cash or redistribute it into bonds ahead of expected forecasting rate cuts. This assumes you have to be in or out and cannot make adjustments. They are not mutually exclusive. You could take a portion of a position, meaning a starter position like Don does with stocks, wait for confirmation, and then add more or take off. Measure what is happening while it's happening and make adjustments accordingly. And you can use bond ETFs so you can be very, very liquid and very easy in and out. Folks, individual bonds are traded in $1 million blocks, 10, 20, $30 million blocks. So the broker at Merrill Lynch or wherever, they're going to buy $20 million of bonds and they're going to spread it amongst all their portfolios. And then you get a $10,000 or $20,000 or $30,000 piece, meaning 30 bonds or 30,000 face value. When you try to sell that, even though 30,000 might be a lot of money to you and a 5% or 3% bond position, to the sale, that's a distressed sale. Your bid ask spread, you're gonna get a bad fill. That's why individual bonds, you got to know how to use them, and you got to know how to sell them and buy them. Otherwise, you'll be in trouble. Alternatively, you can use bond ETFs for easy entry and exit. I would use individual bonds when I think they're going to be longer term in nature. We may be setting up for that very soon for the long interest rate dropping cycle, a longer term cycle. But for shorter and midterm cycles, I'm going to use bond ETFs because I can get in and out with just in 20 seconds. I don't have to go call the bond desk, ask for a quote. They call me back with a bid. I don't have to do all that. And you can trade them online too. All right. One last thing. This is from the same guy. This is another article. It's also in the show notes. Israel and Hezbollah lurch closer to war. U.S. and French diplomats are racing to avert a far broader conflict. That's by Bloomberg. I'm relying on Revere to steer us through these perilous times. Thank you. Me. At Revere, we always stand ready to warn investors of danger that the British are coming. That's why we called it Revere. And steer away and mitigate much of the danger. Folks, there's always things that can come out of left field, whether it's geopolitical, some kind of shock, high inflation, whatever it is. That's why you have to measure and make adjustments constantly. We at Revere do not agree with this pie chart, set it and forget it asset allocation, and then wait for a year and see how things work out. We're making adjustments as we go because things change as we go, right? They change. You don't want to have a static portfolio. Then lastly, the dumbest thing is rebalancing. They love to rebalance on some arbitrary date to make you think that they're actively managing it. Okay, folks, so let's make it real simple. You got a portfolio, 20% in 5 different sectors, different investments, 20, 20, 20, 20. One grows to 30, right? Meaning it went up 50%, right? From 20% to 30%. One went from 20% down to 10, meaning it lost half its value, right? On some arbitrary date, they'll sell down the one that went to 30 back down to 20, and they'll add to the one that's at 10 and add it back up to 20. Sometimes that's watering the weeds. Sometimes that's picking the flowers to water the weeds. I don't want to just randomly just rebalance it to 20%. I will always want to evaluate it and say, wow, that one that went to 30, is that trend still in place? Is that still good? Do I want to add more money to it? The one that went to 10, first of all, you need to ask your broker, why in the hell did you let it lose half its value? Why didn't you have some kind of stop loss and only lost 5 or 8 or 10%? Why'd you let it just wet the bed, right? And you want to look at that and say, is that a weed? Do I want to pick it and just jettison it? Or do I want to add? Is it starting to firm up and looking better? But it never should have dropped that much to begin with. So as far as rebalancing on some arbitrary date, 6 months in the future or annually, folks, we rebalance every day if necessary because things change. Okay? And with that, I am going to go to the guys. I don't want to dive into this. It's going to be way too much. But I did get, there's a good article in the show notes about very good estate planning for the sunset. It talks about slats, grats, charitable remainder trust, dynasty trust, family limited partnerships, all that stuff. If you have any questions on that, that's really technical and it's for affluent people. So I don't want to slow down the show on that. And then also IRS audits are shifting and they're really starting to heat up for middle class. It's not just for the wealthy anymore. So what they told you, they lied. They're starting to spread those new $80,000 IRS agents down to the masses. Who could have seen that coming? All right. With that, I'm going to go to Don, and I want to set it up. Don, the great bear market diversification in that big asset allocation, buy it all. That's one thing. And then what about all this idle cash? I mean, how do you do it at Grotection? How are we managing money? And tell them the better way.
Well, I'm still trying to get over your use of asymptote in that description in that mail.
Listen, folks. Oh, hang on. That's an old joke. I used that a couple years ago. Don is very, very good in math, so I'm surprised he didn't know that term because that's actually a math term. But asymptote means like going up to never quite touching, get infinitesimally close, but it comes up to the line, and so he started laughing last time I used it, so I had to use it again because I knew he'd say something.
It's actually not correct though, because the bond actually does get
Oh,
to
it
the
does
face
get to
value.
par. You're right. Okay, point well taken. Asymptote, you
Okay.
never quite
All
get
right.
there, but
That's
with the
right.
par bond, you do get there. You're right. I stand
All right.
corrected. But the
All
philosophy
right.
was
We got
good, Don.
yes. So I was so stuck on that. What were the questions that you asked me, Dan? You want me to 6 trillion? I don't worry about that. I just yeah, will it come in? A lot of people say people are happy getting their 5% yield with no risk. So the charts will tell us we're not going to invest and stay in something based on the fact that we hope $6 trillion in money on the sidelines is going to come into the market. We're going to go with every day what's actually happening. And your description about diversification, I mean, that's just, we're a different breed of advisor here. The typical Wall Street pie chart that requires no skills. And if you want average returns, invest in the averages. If you want to underperform, get asset classes that are underperforming. It's just not what we do here at Revere. We identify the market trend. We put the pedal down when the trend is in our favor. We back off the gas and start tapping the brake when things pull back, and we apply the brakes firmly if we start breaking moving averages, and especially the long-term 200-day moving average, because that's where all bear markets occur. No ifs, ands, or buts. It's just a mathematical fact that you can't get to 20% down, which is the definition of a bear market, until you break the 200-day moving average. So
We slammed on the
we've set up.
brakes during COVID, Bear.
Yeah, totally. Yeah. I mean, there's times when you just got to get out of the way. We didn't lose 35% in 5 weeks during COVID. And yeah, I know it came back, but what if COVID had a 4%? What if COVID had a 4% mortality rate? Where would we be right now? We just don't really know. Better be safe than sorry. Better be out than wishing you were in than in wishing that you were out. And that's how we pride ourselves in. Our flagship portfolio is named Grotection because it has a dual mandate: grow during uptrends, protect during downtrends. Seems kind of common sense, because every other aspect of your life, if things are going well, you stick with it. If things are going badly, you should take action to fix it. And your portfolio is no different. And Wall Street has been telling people that they're smarter than they are and you can't time the market. And that's just marketing designed to keep you in their product so they can collect their fees regardless of what the market is doing. But let's talk about the market now. And we're showing the S&P 500. Let's look at a 15-minute chart of that, because this is the key that we've been talking about in all the videos. There are the lines drawn. There was the breakout this morning, but we're currently back below that 5505 level, 5491. Can you draw a line above 5491? Because that was the two levels where the breakout failed on June 24th and June 27th. So that's the line that we've been discussing in the nightly videos that we wanted to get above, because the prior attempted breakout on June 20th was just a couple of hours. So technically that was a failed breakout, and that was also above that 5491 level. So if we pull back here to 5491 and hold that, good. Otherwise, we've got another failed breakout, and we were already heavily invested coming into today. The PCE report came out this morning, and it was in line. And the futures, we opened slightly up. We rallied this morning, as you can see on that chart there. And now we've abruptly made a U-turn and pulled back. And if we give up this gain. It is quarter end. There are some shenanigans that happen, rebalancing that happens at quarter end. But if you piled in this morning, you're a little disappointed right now because we've reversed. And that's why we take incremental steps at Revere. We've got our stops in place for everything. Our downside is between 4 and 5% if everything would get stopped out. And we added a couple of things this morning. And really what we're watching is that 54.90 level. Ideally, we stay above 55.05. That cements the breakout. And on back tests, that should hold. If it doesn't, then the market's not quite as strong as people were hoping for. And that bottom line there that's drawn across around that 54.50 level, that is the big key. We do not want to break back below there because that's been the consolidation level. And you should, when you break out of a consolidations, should resolve in the direction of the primary trend, which was up, which we saw this morning. But if they don't, and you pull back, then that's telling you it's a failed breakout, and from failed moves come fast moves in the opposite direction. So we're very wary about that. But breaking 54.40 to 54.50 would be a change in character, and we would take some defensive action on that. We're ironically coming into the two strongest weeks seasonally in the market. The first 2 weeks in July during an election year, particularly, are extremely strong weeks. And then the market tends to weaken late July through August and September. And we're wary of that also. Again, that's a secondary indicator. We've been following seasonality so this year. I mean, the trend is up, but on a month-by-month basis, we haven't really been following it. But as always, we got stops in for everything that we own. We've got our list of stocks that are outperforming. We know where our low-risk entries are. We know if they don't work, we'll get stopped out for a small loss. And if they do work, we'll continue to let them run. And that's the take on the market. It's really a level-to-level market. We break levels higher. That's bullish. We fail at those levels. That's cause for concern. We break down at the lower level. That's bearish. Did I say bearish the first time? I meant bullish. We break below the lower line. That is very clearly bearish and calls for some action to occur. Not pie chart guys that sit with their feet up on the desk, bouncing the tennis ball off the wall or out golfing. We're actively managing risk in real time as things happen in the market. The market trends higher long term, but part of that long term trend up is a lot of short and intermediate term trends that can be very painful to the downside, and we want to avoid those so that the sleep at night factor is in place for our clients.
Well, especially if you're in retirement, or right at retirement, if you incur a big drawdown and you're having to take a lot of money out or some money out, then you don't get the compounding recovery that you expect when you look at that long-term retirement plan spreadsheet they gave you where you make 8% a year and you start, you make the 8% annualized over the long term and then you start taking money out. Well, if you get a big drawdown and you start having to take money out, you don't compound. If you control your drawdowns and you have a much shallower drawdown, you compound from a higher base. So it's even more important the older you get.
Yeah, and it's also the older you get, your account should be at the highs. So that's why those pullbacks, that sequence of returns is so critical, because compounding works opposite to you to the downside. So if you had half a million and you lose 10%, it's losing $1 million and being down 10%. One goes from 500 to 450. The other one goes from $1 million to 900,000. It's a much bigger hit, and it's harder to get back to that level. So that's why we are aggressively defensive when we need to be at Revere. But when the trend is up, we're with the trend. We're not fighting it. We're going with what the market is telling us.
Okay.
So let's go to the fellas are going to talk a couple of trades this week. Let's start off with Connor.
Yeah, so this week, going to talk about a losing trade along with a winning trade right now that's still open. So Ted, if you just pull up Amazon on MarketSmith. So I'll kind of walk you guys through what I was seeing what I was thinking and kind of like the characteristics. So first, from a fundamental angle, Amazon checked a lot of the boxes, right? Great earnings, great sales. The free cash flow on Amazon is huge. So all those boxes were checked. Story-wise, you have the integration of AI with Alexa, so you're seeing that angle. And then another thesis that I was having is that, right, we've seen a lot of the big tech stocks. They've been the best performers, but Amazon hasn't broken out yet. So part of the thesis was, if money continues to flow into these big tech names, is Amazon going to catch up? And from the price action, that's what price was saying. So on Wednesday, that's when I bought it as it broke out through that 191.70 pivot. On that day, it was trading about 60% above average volume. I was up over 1 ATR in the day, so that kind of tells me this is real buying. This isn't just a pop and drop like it's done the other times at that spot, and it closed near the high of the day. And my stop loss for this one was right at the 50-day. So you can see those moving averages were super clumped together. So it was quite a low risk entry because, that's 821 and 50-day all stacked on top of each other. We call that the power 3 setup. And that can be, that's sometimes often a signal that expansion's coming. So that was a plus. And the opposite side, it gives you that clear level to risk off from. So it followed through the following day on above average volume, which is always what you want to see. And then today it's pulling back with the market right now. But overall, it's acting fine. And one characteristic of this base is look how many times it failed at that 191 spot. And that's something I've noticed with some of the best breakouts occur when the most frustration happens, right? Because it tried breaking out over 3 times and failed. So most people are probably worn out by now and they're like, oh, this thing's never going to break out. It just keeps failing. But on Wednesday was the first time that it had the volume to support it. And it's flying through so far. So acting good. The hope this can continue higher. And then one thing I'm going to give some homework for the listeners, basically on the point I just said about the failed breakouts and breakdowns. If you look at NVIDIA, the January 8th breakout, just go back and look at how many times NVIDIA tried to break out and break down in that base before finally going. And then if you check out SMCI January 19th, again, same situation. Count how many times it tried to break out, tried to break down in that base before it actually went, leading to a powerful move. So that's a characteristic that I've seen in some of these base breakouts. Okay, so now going to talk about a loser, and this was NXT. So some thoughts about the trade. I was seeing bottoming action in the solar group, TAN, which is the solar ETF, that got back above all the moving averages. And from a stage analysis perspective, that had bottomed out. There was accumulation, big volume bars in the base. So that was another green light. And what I liked about this TAN chart was you can see it's obviously been underperforming, and then it shot right back up on huge volume above the 200-day moving average. And then it had about 6-7 days of tight action forming a flag. So 6.5 was my initial buy as it held the 8 EMA and closed near the high day. So that was the first buy, and my stop was at the 21 day. That was about 3% lower. And then on a couple days later on 6.10, I did a follow-up ad as it was breaking out over that 58, 59 area pivot. And it was acting good. It shot up to that 62.31 level. And you can see on the left side, there was some overhead resistance on the left side. And my thought was that maybe this handles out on the right side a little bit, consolidates, and for a move higher. And it started doing that. So it pulled back a couple days right into the 8 EMA, and the 21 was right there. And I thought that was totally normal, right? After a big move up, stocks need to digest and digest the gains, and it was looking like a cup and handle. But when this was pulling back, the TAN ETF started to fall apart. First Solar, which was the leader in the group, started to roll over as well. So there were some warning signs there. And besides NXT and First Solar, there was really no other stocks in the group. So 620 was when I sold the second ad. It broke the 8 EMA. This was right around for a 1% loss, as the first buy was underwater. And the second buy was still profitable, so it was holding that. And then the following day on the 21st, NXT broke the 21 day and sold the initial buy right at cost. And, and now look at the chart now, right? It's about 15 to 20% lower from where I sold. So, this just goes to show that quick losses are the best losses, because if you just fall in love with the stock and don't listen to price, that's when you can get yourself into trouble. So now looking at this chart today, looks pretty bad. It's sitting back at the 200 day. First Solar's getting smoked again today, and I think Don's going to talk about that one. But this is just a case where, I had a thesis about the solar stocks, the solar group, and plain and simple, it fell and got out with a super small loss, and that's that. So that's one winner and one loser.
That's absolutely right. It's okay to be wrong. It's not okay to stay wrong. And when I say wrong, the stock could be setting up, and you take that setup, and all of a sudden it changes character and something happens and it starts to fall apart. So it's not that you were technically wrong getting into it. It's just things change, and now it's wrong. So now you got to make an adjustment to your strategy. If he hadn't have done that, he'd be down 20% on the stock. That's how you manage risk. All right, back to you, Don. Sorry, I just had to jump in there.
Yeah, can you bring up First Solar, Ted? First Solar, we noticed that although the overall sector was terrible, and you can see First Solar trending back here late last year and early this year under the 200-day moving average, as part of our normal reviews, we noticed some relative strength coming in to First Solar, so it got our attention anyway. Sometimes when sectors are at the bottom in rankings and they start to make the turn, that's one of the best times to identify the leader in the sector, try to get into it early, and then as the sector strengthens, that will be reflected in the price of the stock. And this just dovetails exactly on what Connor was there, it didn't. Now, right now, we're just pulling back to the 50-day moving average for First Solar, so it doesn't look that bad. But if you look at TAN, this is the solar ETF, that's terrible. If you look at what was the number 3 stock in the group, Enphase, it tried to have a breakout back here and failed, and that was just 2 weeks ago. And then, of course, Connor showed NXT, which has also had a failed breakout. So First Solar, we got into it, we traded it. We had some good returns. The size wasn't very big, so then we still ended up with a plus 6R trade. That means that whatever we risked, we made 6 times the risk. That's one of the ways that we calculate how we're making progress. But with earnings right here, this was the first buy. It got extremely extended. We took some off. It continued to go higher. It had a nice consolidation here, and we bought again when it broke out here, but then it immediately failed. So we sold the breakout right away. Don't ignore failed breakouts. That's telling you something. That coupled with the fact that the overall sector wasn't acting well at all. And then when we broke the 21-day moving average, we got rid of the rest of it, and now we're down to the 50-day moving average. But this is where we want to buy something. The moving average sector is not in favor. So Ted's segment is going to be on his new favorite AI. Well, it's an LLM. And it gives you a choice of which chatbot you want to use, right? Ted, or not chatbot, but which AI engine you want to use. And Ted's going to talk about that.
Yes, Don. So I'll be talking about Perplexity.ai. And ever since I discovered this LLM search engine, I've probably replaced over 90% of my searches from Google onto Perplexity. And it's quite amazing. And I'm really excited to show you guys a video of me demonstrating some of the use cases that I've found and that I use in terms of our portfolio management, trading, and investing.
So, as part of the podcast, I wanted to record this special segment. Um, in the segment, I'll be covering Perplexity.ai. So, simply just go to Google, type in Perplexity.ai, and you'll pull up this page. And I have the pro version, but even if you use the free version, pretty much all the features are there except one thing, which I'll show in this video. So when you come to this page, you have this home page, and just like Google or any other search engine, you can type whatever you want in here. And what is really cool is you can have these focus features. So you can have it searching only academic papers. You can have it focused on generating writing or text, even searching Reddit, or even just videos in general. And what Perplexity is, it's to me an advanced form of Google and search, and they completely reimagined the way we search. And personally, I've replaced probably 90% of my search from Google onto Perplexity. And so the three areas is the homepage where you can type in new search and the various features. Discover, this is kind of like a news page, and they have AI curated top pieces of news every single day. So the most recent one from 12 hours ago is NASA hires SpaceX to destroy the International Space Station. So if you just to click on that, this is created by the Perplexity team. And what Perplexity does is it goes to the internet and scrapes any relevant article or piece of information, websites, and generates the best answer, the optimized answer to what the AI and the language model believes, and it just spits it out. As you can see, talks about the contract, gives a lot of specific information. And the beautiful thing about Perplexity is it cites its sources. So if you want to fact check it, you can just simply click that and it brings up the website, and then you can quickly skim through it. And so that is the Discover page, which brings a lot of nice pieces of news, the top pieces of news for the day. And then after you search on the home page, they have a library page where it stores all of your previous searches, and you can create collections to filter out and kind of save your most important sources in folders and categories. So I wanted to just showcase a few use cases now of how I use Perplexity. The first one is just simple search. We know that PCE came out today, so if you're wondering what PCE was and don't have access to a paid news outlet, or you just wanted some interpretations and narratives surrounding PCE, you can ask it this question, which I did. What was PCE today, and what are the various interpretations and narratives surrounding it? Like if you just look at it, it goes into the BEA.gov website, it goes on Market Watch, it goes to investing.com, and 14 more other sources that you can look through. And what they do is, instead of you sorting and filtering out the signal from the noise, they give you what they think the signal is. And so it gives you the headline 2.6 year over year, which is extremely accurate. Unlike other large language models that don't have the search feature, they can often hallucinate and just create up and come up with lies about what you want. And now they also have some interpretations and narratives surrounding this data. For example, disinflation trend, Federal Reserve's preferred measure of PCE, comparison to PCE. So what comparison to CPI? So what is the difference between CPI and PCE? Economic implications, the market's reaction, policy outlook, and it gives you a quick summary. And if you have more questions, you can ask a follow-up here. And they also have some just preset questions that they think are relevant to your initial prompt. For example, how does PCE inflation report impact the stock market? You can click on that and does its research, and it spits out an answer. Talks about how it impacts Federal Reserve policy, market expectations, bond yields, consumer spending. So that is the first way I use Perplexity. And to give another example, we are long TMDX, and if you want to know what happened on April 30th in its earnings report, you can just ask it and ask what the significance of the result is. And it's quite amazing that since it scrapes internet and sources, it actually provides it provides all the necessary and relevant data and information regarding your prompt, and it's very accurate as well. Revenue growth, profitability, gross margins, guidance, raising guidance. So continue on. You can ask the questions, for example, if there's a complicated concept you want to explore, you can ask the questions. And what I did was explain CRISPR and the various advancements to me like I am a guy on the streets without a background in biology and chemistry. And what CRISPR essentially is, it started off as a bacteria immune system, but scientists have used the system to now edit DNA. And so this answer really just gives you a summary of what CRISPR is, how it works, various parts of the CRISPR, like the guide RNA and the Cas9 protein. And then it spits out all the other relevant pieces of information regarding advancements in medicine, agriculture, the ethical considerations, and then a conclusion. And it even gives you a YouTube video, which you click on. It's pretty amazing, from Mayo Clinic. And go through that, watch the video, and then if you want more information, you can continue to prompt as many questions as you want. Another use case, for example, what if you wanted to choose an investment advisor? And so what I did here was, you come across Revere Asset Management and want to find out what they do. I asked, tell me everything I would need to know about choosing Revere Asset Management as an investment advisor. And this is actually really amazing. Gives you an overview of about approximately how much money we manage. Of course, not going to be completely accurate because of just periodic filings. Talks about the various services offered, educational content, which is true. We do the daily videos, the podcasts, and the weekly videos. Dan does a lot of the comprehensive life planning. And then, of course, we do the active portfolio management. And that really sums up what we offer. And look, it even goes to the investment strategies. Grotection is our flagship portfolio. We have robotection for smaller accounts. And we also have just a blend of robo and grotection for even smaller accounts. Kind of outlines our principles and our values, transparency and communication. Dan and Don definitely emphasizes that all the time on the podcasts and daily videos. Talks about the leadership. Dan Stewart, CFA, just quickly talks about his 20 years of experience, and then a conclusion. But for example, let's say I want to find more about Dan. I can highlight his name and ask a follow-up. And then I'll go onto the internet and search everything about Dan. For example, went to his LinkedIn, Investopedia, Twitter, our website. It's just amazing what this tool can do. And here we go. It spits out everything about Dan. Everything I'm reading here seems completely accurate so far. And yeah, so that's another way you can use this. And finally, I want to show this feature, which a lot of LLMs have, called the vision feature, where if you import a photo, in this case, I imported the global liquidity cycle. For example, you look at this, you're like, what is going on? So you prompt it, interpret this chart for me. And it looks at the chart and tells you exactly what it thinks it's happening. And yes, it's the global liquidity index. It follows a sine wave, a 65-month wave where it oscillates between highs, peaks, and troughs. And that is how the global liquidity cycle moves. And yeah, those are some of the things I want to show you regarding Perplexity. On this side too, you can generate images. For example, let's say a photograph. You generate search for videos too, and search for other images. It's just an amazing tool. Let's see let's see what else we have. For example, let's go into finance real quick. I was looking at credit cards the other day, and I want to know what are all the best airline credit cards, and boom, it just spits out all the best airline credit cards, annual fees, rewards, the bonuses that each credit card gives. And so just want to share this piece of tool that we use at Revere for some of our research for boosting our efficiency in the markets and portfolio management and our trading. And if you have any questions about this tool, or just if you've found any other use cases, feel free to email us. My email is ted@revereasset.com. Dan and Don's is Dan and Don@revereasset.com. We'd love to hear what you find about Perplexity. It's just an amazing tool. It's so beneficial in your personal life, in your work life, just everything. And AI is definitely going to change how we live, and it already has.
All right. Well, Don, do you have anything else you want to add about the markets?
No, we're breaking back through that level that I pointed out this morning. So as of right now, we're looking as of 12:40 time. We're looking at a failed breakout this morning on the S&P 500.
All right. Folks, listen, if you like what you heard, please tell a friend, tell a neighbor, just send them to revereasset.com. They can go up in the right-hand corner and they can hit the subscribe button and they can put their name and email in. We're not going to hassle them or reach out to them. It's up to them to reach out to us for a complimentary portfolio review or any topic or even stock they want discussed on the show. And there's a contact button next to the subscribe button if they want to send a message directly to me. They can also email me directly at dan@revereasset.com or don@revereasset.com or Ted or Connor @revereasset.com. And you can always call us old school at 855-REAL-WEALTH. Folks, we'll talk to you next week on Your Money.
It's not about how much you make in the markets, it's about how much you can keep.